The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Income Tax Gotchas in Life Insurance Planning. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you very much, Amber, and welcome everyone. I'm glad you joined us for today's webinar, Income Tax Gotchas in Life Insurance Planning. Before we get started on today's webinar, let me remind you that next month we'll be talking about the Section 72T exception to the penalty tax. That will be on Wednesday, April 3rd at our usual time, 11 a.m. Central. These webinars are free and open to anyone in the financial services industry that you think would benefit from hearing the content. And so if you find the content that we give valuable, please pass word along and invite others to attend. Our regular day is the first Wednesday of the month at 11 a.m. Central, and we post our recorded webinars on our YouTube channel, and that'll be available. Today's webinar will be available in recording form before the end of this week. So before we get too deep into today's topic, let's go ahead and decide what it is that we're going to talk about in May. Your three choices for May are, first of all, reviewing Form 1099 LTC. The second choice is state income tax and withholding rules. And the third choice is fighting with the IRS. I'm going to go ahead and launch the poll and ask you to vote for May's topic. The poll is now open. Go ahead and cast your vote. Waiting for a couple more votes. Give you another second. Anybody who hasn't voted, please do so. All right, I'm going to go ahead and close the poll. And next month's topic will be state income tax and withholding rules. State income tax and withholding rules. Thanks for voting, and thanks for helping us make our webinar a success. All right, let's go ahead and talk about some income tax gotchas in life insurance planning. And today we're going to talk specifically about 5 examples. There are more. And if you're interested in hearing about more, ask for the newsletter, and we'll tell you how to do that at the end of today's session. But here are the 5 examples that we'll talk about today. We're going to talk about first the transfer for value rule and how that can make death benefits on a life insurance policy income taxable. We'll talk about the Section 101J rule, which can also unintentionally make the death benefits from a life insurance policy income taxable. We'll talk about transfers of life insurance policies from a business to the owner of a business. It's a question that we get asked about quite a bit at Advanced Underwriting Consultants. People get confused about the tax consequences of making such a transfer. We'll talk about loan forgiveness in connection with a Section 1035 exchange and how that can create a potential tax problem, and it's a tax problem that's often overlooked by life insurance professionals. And then we'll finally close it up with business-owned coverage where there's a personal beneficiary named and how that can create an income tax problem as well. So those are the 5 things that we'll talk about today. Let's go ahead and start with the first on the list, which is the transfer for value rule and how that can make death benefits income taxable. So the source for this is Code Section 101J. And 101J says that life insurance death benefits are income tax free. And the key provision there is 101A1, and I'm going to highlight, hopefully I'm going to highlight, highlight the right part of this. Gross income does not include amounts received under a life insurance contract. So that's the general rule. If such amounts are paid by reason of death of the insured. So that's, if anybody ever asks you, what the source is for life insurance proceeds being tax-free, it's Code Section 101A. Now, the transfer for value rule follows immediately. And so if there's a transfer of a policy in exchange for something, whether it's money or a promise or anything of value, right? Then what the code says is that the amount excluded from gross income shall not exceed the basis in the contract, right? So not all the death benefits tax-free under those circumstances. It's just a return of basis that's tax-free. Everything else is taxable. So any transfer for valuable consideration makes the death benefit income taxable, but there are some exceptions, and that's in Section 2B. And that the exceptions are transfers to the insured are an exception, to a partner of the insured, to a partnership that includes the insured, or to a corporation in which the insured is an officer or a shareholder. And so transfers of life insurance policies, between businesses in a business setting, we should always be worried about whether the transfer for value rule might apply, which would make the death proceeds income taxable. But we have some specific exceptions: transfers to the insured, to a partner of the insured, to a partnership that includes the insured, or a corporation in which the insured is an officer or a shareholder. Those are exceptions. Note that a transfer to a co-shareholder of the insured is not one of the exceptions. And so that's why I say you have to kind of carefully evaluate transfers of life policies and evaluate with Section 101 in mind as to whether or not the transfer for value rule will apply. Obviously, we want to avoid the application of the transfer for value rule where we have a choice. So there you go. All right, let's go ahead and talk about the second thing, which is failing to conform to Section 101J, which can make death proceeds income taxable. So we're going to read from the code again, and I'm sorry about that, but here we go. Code Section 101J says that if a business owns a life insurance policy, then any amount that's paid to the business out of the death benefit in excess of the premium is income taxable. Yeah, right. That's what it says. It says For a business-owned policy, any amount paid in excess of the premium as a result of death is income taxable. But the good news is that there are exceptions. And the exception, first of all, requires a certain status to be recognized between, or a certain relationship between the insured and the business. And you can see them here in subsection 2. Any amount where the insured was an employee or at the time the contract was issued was a director or highly compensated employee, an employee during the year before death or at any time when the contract was issued was a director or highly compensated employee, they potentially qualify for an exception to the rule. And I say potentially qualify for the exception to the rule because you got to get the notice and consent form signed prior to the coverage is issued. And the good news for those of us on the call is that a lot of the carriers that we work with make Section 101J compliance part of the process when we've got a business-owned life insurance policy. But based on what Jennifer and I here at Advanced Underwriting Consultants, sometimes carriers, at least a few carriers, still don't do that. And so it's up to the agent to make sure that we've got a situation where there's an exception to 101J and that the proper notice and consent requirements have been followed prior to the policy's issue. If we do that, we still get a tax-free death benefit. If we don't do that, the death benefit is taxable. And so we need to be aware of that as life insurance professionals about the 101J rules as they might affect business-owned life insurance. So let's go ahead and go on. The third gotcha is transfers from a business to an owner employee can create a taxable event. And the reason that this is included in the list is because Jennifer and I get a lot of calls from people who confuse the transfer for value rule with taxation of a transfer of a policy, right? They think that because a transfer from a business to the insured is an exception to the transfer for value rule, there are no tax consequences associated with transferring a permanent policy from a business to the business's owner. That's not true. There are tax consequences when a policy is transferred from a business to the owner. And the actual nature of what happens depends on how the business itself is taxed. And the first analysis is that in a partnership, a transfer of the policy from the partnership to the partner just reduces the partner's basis in most cases in the partnership. There are really no other income tax result. It generally reduces the partner's basis in the partnership. And that's true of an LLC taxed as a partnership as well. In an S corporation, the result's a little bit different. When the company transfers the policy, it's a taxable disposition, and therefore it is treated as a surrender, a taxable surrender of the policy by the corporation. And then the distribution of the policy reduces the shareholder's basis in the business. So in one way, it's like a partnership in that the distribution reduces the shareholder's basis in the business. But the transfer of the policy by the S corporation is treated as a surrender, whereas in a partnership, it's not treated that way. And then finally, in a C corporation, in a way, it's the worst of all worlds. Transfer of the policy from the C corporation to the insured, first of all, is treated as a taxable surrender of the policy by the corporation. So if there's any gain, the corporation will recognize that. And then there are two paths that that might be applicable when the policy is transferred. First of all, it might be taxed to the owner as a dividend. If dividend treatment is chosen by the C corporation, that means it will be taxed as a dividend by the insured recipient, and the dividend distribution is not deductible by the business. And the alternative is that the distribution to the new owner may be treated as compensation. And if it's treated as compensation, then it is also taxable to the recipient, might be taxed at higher rates because it's compensation rather than a dividend. But on the plus side, compensation distributions are deductible by the business. And so that's a quick overview of the different kinds of tax results that can be associated with a transfer of a policy from a business to the insured. Let's talk about loan forgiveness in connection with a 1035 exchange and how that might create a tax problem. We get asked about this an awful lot, and it ends up being a surprise to a lot of people who have never run it into before, who have never run into it before. And so the situation usually arises where a client owns a permanent life policy, it's got a loan against it, and they want to change it for a new loan-free policy, maybe for performance issues or some such thing. And the rule is that if you do a 1035 exchange of a life policy, but a loan disappears as part of the transaction, the loan is treated as taxable boot. And the weird thing about boot is that it's taxed gain first. And so you have to compare the owner's basis in the contract to the surrender value plus the outstanding loan to figure out whether there's gain. If there is gain, and if the loan is extinguished as part of the 1035 exchange, that gain is going to be recognized to the extent of the indebtedness. And that can be an unexpected problem for people who have big loans against their existing life insurance policies. Now, in the past, many companies have had loan exchange programs, and the IRS has said that where you exchange a loaned up policy for another policy that's got a loan of at least the same amount, that's a valid tax-free exchange. There's no boot in that kind of transaction. The problem is that most insurance companies won't do loan exchange programs. And if they do, they generally limit those programs to just selected really big policies. And so that's not available in a lot of cases. And so, what's the policy owner stuck with? Well, stuck with paying off a loaned up policy with funds from outside, then doing the exchange, and then, if needed, accessing the cash from the new policy post-exchange. And the other choice is just, biting the bullet and paying the tax associated with having the loan exchanged as part of an exchange to a new policy. That's usually what our clients are stuck with. If you've got a situation where you're trying to figure out what the best thing to do might be, we invite you to give us a call about that kind of thing, because working through those issues can kind of be tricky. And then the last tax gotcha that I want to talk about is how business-owned coverage with a personal beneficiary can create a tax problem. A lot of times we get asked about that, where the business wants to name the insured's personal beneficiary on the policy. The bad news is that there's a court case that says that when you do that, the business is considered to be making a taxable distribution to the personal beneficiary of the insured. And you can see on the box in the middle of the page that the key case on this is Golden versus Commissioner. It's been there for a long time, since 1940, and also Revenue Ruling 61-134. Problems can also come up in personal situations, but the income tax problem arises in the business situation, where we've got a business owner, a business owning the policy, naming a personal beneficiary on the policy. That makes the death benefit income taxable, and it is something to be avoided. So what are the lessons that I invite you to take away from today? The tax gotchas we discussed, they're overlooked sometimes even by experienced life insurance professionals. So I hope the reminder today will help keep you from overlooking that, and helping your client to avoid these situations. Anytime you're proposing something that seems sophisticated, all aspects of the transaction should be carefully evaluated for any potential downsides. And if you'd like to get the full list of gotchas, ask for a copy of the newsletter article that supports today's webinar. I'd like to thank you again for joining us today, and I'll turn the program back over to Amber to close us out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, April 3rd, at this same time. Next month's webinar will be titled the Section 72T Exception. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again and best wishes for continued success.